This is the first in a series of videos in which I share with you all, or attempt to share with you all, my 10 years of studying supply and demand. So let's take it back to the real basic meaning of supply and demand. And it is phenomenon. The laws of supply and demand are fundamental principles of economics that describe how prices are determined in a free market economy. So let's take the first law. That's the law of demand. And it states that assuming all other conditions remain constant, as the price of a good or service rises, so does the amount that is desired of that good or service. In other words, if a good or service price rises, typically consumers are less eager to purchase it. All right, so let's start drawing the analysis. All right, so this is the supply and demand chart, and this is going to be price and this is going to be quantity. And what the demand slope looks like is a line that's represented. We'll put that in green. So again, when prices are high, you're not going to go out and spend a buku amount of dollars. However, when the prices decline, you're more inclined to buy more of that item. For example, let's take eggs. Before the pandemic, eggs were selling, pastured eggs at Whole Foods were selling for, say, $2. And then when the pandemic hit, a year later, those same eggs, dozen of eggs were selling for like $4. So I was less inclined. I was only buying like 1 dozen a week. But then prices started dropping, and when they started dropping, I was upping the quantity from 1 dozen to 2 dozens. All right. All right, so let's look at the other law. It's the law of supply. And it says assuming all things remain constant, when the price of a commodity or service rises, so does the quantity supplied of that good or service. In other words, as the price of a good or service rises, providers are typically prepared to create and sell more of it. A supply curve with an increasing slope is generally used to represent this relationship graphically. So this would look like a upsloping line on the chart. And the example is the EV markets and the adoption of EVs. And you need lithium to create the batteries to power the car. And as EV makers started selling more and more vehicles, the supply of lithium started to get stretched. So what did Albemarle and other companies do? They started mining more lithium because as the price was going up, it was an opportunity for those companies, those miners, lithium miners, to make more money. So that's an example of the law of supply. Now, what's the equilibrium point? It denotes where price and quantity have reached a level where there's no real imbalance between buyers and sellers. And then you have the equilibrium point, which denotes the price and the quantity at which the market clears, is where the demand and supply curve intersect. To put it another way, it is the point at which there is neither an excess of supply nor a surplus of demand for that particular item or service. Market equilibrium occurs at the equilibrium price and is absent a shift in either the supply or demand curve. There is no tendency for price to change. And that's denoted by this intersection right here. So we're going to denote that. Let's move that over. Okay, I'm going to do it this way instead. All right. We'll put that in red. And we'll represent that with a dotted line. Again, at this point, it's really fair value. With the buyers and the sellers are equivalent. Again, there's not an excess of supply or demand. Price is at fair value. Quantity is where it needs to be. So what this looks like is if price increases, let's put overhead, supply, demand, let's put an up arrow. And we're going to represent so if price increases, supply is going to go up, right? Because you want to make some money while the prices are high. However, demand's going to go down because I don't want to pay wholesale prices for that same item that I got cheaper the previous week. So what happens if prices decrease? Well, supply is going to go down and demand is going to go up. So if I'm selling something and prices go down and I sell it, I'm going to be losing money. However, your loss is my gain. I want to buy as many of those items or services while they're selling at a cheaper rate than they were the following week. So that's the dynamics of supply and demand. So what is trading supply and demand actually? Supply and demand trading is a type of technical analysis used in the financial markets to identify key levels where the price of an asset is likely to change direction. This approach is based on the laws of supply and demand and assumes that market prices are driven by the interaction between buyers and sellers, primarily the institutional investors. Institutional investors have great influence and impact on the market as they have the advantage of professional research, traders, portfolio managers guiding their decisions. And they have the capital to move the markets. So let's expand on the institutions. Who are the institutions? Institutional investors. All right. So we have the banks. Let's draw a couple of these here. All right. And let's draw one more. All right, so we got the banks as one. You have insurance companies. You have pension funds. You have hedge funds. You have investment advisors. You have university endowments. You have more prongs. All right. Okay. You have private equity groups. And last but not least, you have mutual funds. These entities constitutes the institutional investor. All right, so institutional investors make money because they understand how the markets work and know how to identify and trade supply and demand imbalances. We, the novice retail traders, almost always lose money, right? Trading is a zero-sum game. Someone's gain is someone's loss is someone's losses. So What do? They buy after rallying price. Oh no, FOMO. And they buy into a price level where supply exceeds demand, which guarantees a loss. To be a successful trader, one needs to be the seller at this supply level and not be the buyer at the supply level. Then on the other hand, they sell after a drop in price. Oh no, I'm losing money. They sell into a price level where demand exceeds supply. To be a successful trader, one needs to be the buyer at the demand level and not the seller at the demand level. Trading supply and demand focuses on locating areas of supply and demand imbalances, or regions where there is either an excess of consumers' demand or sellers' supply. Price charts are commonly used to identify supply and demand levels, which can be done by looking for prices where prices have previously reversed or where prices have consolidated for a while, which suggests the idea that supply and demand are out of balance. Keyword, out of balance. When it comes to supply and demand pattern formations, there are four. You have the first one, a drop, base, rally. This pattern occurs when the price drops sharply, then consolidates for a period of time, then rallies. So the drop is seen as a sign of selling pressure, while the consolidation is seen as a sign of indecision, and then the rally is seen as a sign of buying pressure rather. The other formation is the rally, base, rally. The pattern occurs when the price rallies sharply, then consolidates for a period of time, and then rallies further. The rally is seen as a sign of buying pressure, while the consolidation is seen as a sign of indecision. The further rally is seen as a sign of continued buying pressure. So that is the second formation is the rally-based rally. The pattern occurs when the price rallies sharply, then consolidates for a period of time, and then rallies further. The rally is seen as a sign of buying pressure, while the consolidation is seen as a sign of indecision. The further rally is seen as a sign of continued buying pressure. So that is the rally-based rally. Then you have two formations in the supply level. Drop, base, drop. This pattern is the opposite of the drop, base, rally. The price drops sharply, then consolidates for a period of time, and then drops further. The drop is seen as a sign of selling pressure, while the consolidation is seen as a sign of indecision. The further drop is seen as a sign of continued selling pressure. Last but not least, you have the rally base drop. This pattern occurs when the price rallies sharply, then consolidates for a period of time, then drops further. The rally is seen as a sign of buying pressure, while the consolidation is seen as a sign of indecision. Then the drop is seen as a sign of selling buying pressure. Last but not least, you have the rally-based drop. The pattern occurs when the price rallies sharply, then consolidates for a period of time, then drops further. So the rally is seen as a sign of buying pressure. The consolidation is seen as a sign of indecision. Then the drop in price is seen as a sign of selling pressure. These are the four formations. You have the drop, base, drop, drop, base, rally, you have the rally, base, rally, you have the drop, base, drop, and you have the rally, base, drop.